Welcome to Africa Business Weekly, your go-to source for the latest business news and trends in Africa. From market insights to how global developments impact Africa, we'll keep you informed and ahead of the curve. I'm your host, Akin Obakeye. Let's dive into this week's top stories and explore what's shaping the future of business in Africa. In South Africa, what is the future of the region's agri sector if the United States fail to renew AGOA? Meanwhile, in East Africa, Djibouti is becoming a key hub in attracting institutional partners. We'll find out what can be done to de-risk investment and strengthen local capital markets in the region. Also in West Africa, we'll be finding out what the drivers of the full-year results of Afreximbank and the Africa Finance Corporation. But let's first cross over to Johannesburg and get updates from Karabo.
Thank you, Akin. Well, South African citrus, grapes, wine and fruit juices have been the topic of discussion at most dinner tables lately as industry stakeholders contemplate what the official removal of AGOA could mean. And under the preferential trade deal with the US, around two-thirds of South African exports to the US benefited from the free trade area deal. To discuss the implications for the local agricultural industry in a post-AGOA world, our senior anchor Fifi Peters spoke to Wandile Sihlobo, chief economist at the Agricultural Business Chamber of South Africa.
If that could happen, that would be excellent for us. In 2 weeks' time, South Africa's citrus industry will be starting with the export season. So a 90-day suspension while the US still digests all of these things around tariffs, if that is true, that would be a welcome relief on our side. I guess it would also offer us an opportunity to really think thoroughly on how should we engage with the US, because I think there's a broad agreement now that we do need some form of a trade agreement between South Africa and the US. And of course, as that is being thought about, it could be a medium to long-term approach. But in the near term, trade has to happen. And unfortunately, in agriculture, we have these perishables that should be coming to the market. So that would be something that would be good if it does materialize.
So we did have a trade agreement. We had what was called AGOA, and I see that that's up for renewal in 2025. So by you saying we need to re-engage, are you also taking the view that we're potentially out? In fact, we are out of AGOA in the eyes and the ears of Mr. Trump.
I mean, I think there is a broad acceptance in South Africa. If you reflect back in 2014, when we were still thinking and engaging on a renewal of AGOA, it was clear then that we were somewhat on an upper income middle class country, and there was a lot of challenges about whether we qualify or not technically on that. But I think South Africa needs predictability as to what actually happens in terms of trade. And I think what we view as a better room for predictability would be some form of a free trade agreement or even preferential trade agreement, because AGOA, as it stands, I mean, it's unilateral. It depends what the US says. And of course, South Africa has gotten into a crosshairs for a number of things. The issue of Lady R, the politics of BRICS, the politics of the Middle East, and many others, which is why then we think if there are all of these challenges that often come up every now and then, it will be better to have a much more preferential approach on this. But Vivi, let's also face it. I mean, if you look at countries like Kenya, which already started earlier to negotiate around a free trade area with the US, even now with the tariffs that were announced last week, they got far lower tariff levels of about 10%, while we were sitting at 31%, which means then that there is benefit in thinking about free trade agreement with the United States as a medium term to long term. But AGOA, I think we are closer to actually graduating out of that process as South Africa, if indeed not nullified by these tariffs, which in our view we think it has been nullified by them.
So by many people's scores, Mr. Trump is not too happy with South Africa. He says repeatedly every time he mentions the country's name that very, very bad things are happening over in South Africa, and unfortunately the news is not picking up on it. So in the event, I'm just going to take the worst case scenario, and I know journalists shouldn't be so negative, but I'm just going to do it in any case, just behave as I am accustomed to doing, unfortunately. In the event that our conversations with Mr. Trump are not as successful as Kenya's conversations with Mr. Trump, does that deal a significant blow to the outlook of our agriculture sector? I mean, we're talking about the citrus and the wines and the fruits and all the other stuff that go to the US market that the US consumers like. Or do you see other markets presenting an opportunity that could potentially offset the potential loss of volumes that would ensue from the US?
I mean, our thinking is that South Africa should continue with the diversification approach, looking broader to Asia, Middle East, parts of Europe, and elsewhere on broadening the export markets. But the reality is that we cannot switch the US in the
Momentum in South Africa's equity markets sparked by the May elections last year maintained its pace in 2024 since a business-friendly GNU was installed in early July and months without any disruptive rolling power blackouts. Coming into 2025, investors are looking for companies to deliver on projections for increased profits. For more, CNBC Africa's Anastasia Arendse spoke to Dirk Steffen, Chief Investment Officer for EMEA at Deutsche Bank.
This is really breathtaking what we see, right? We had a huge sell-off after Liberation Day, of course. Question I may ask is liberation from what, right? But anyways, so it's been delivered quite a blow via these tariff announcements to the global economy, I may say, and especially to the US economy. And then, of course, we had a sell-off we hadn't been seen since COVID at least. And then we actually entered this week's trading in something that's now already labeled Manic Monday, right? Where, we had intraday moves of up to 9 percentage points if you look at the NASDAQ. So huge volatility. And today is actually a positive day where there's talk of trade negotiations, mentioned by Besant. So this is keeping us very busy indeed.
As you have conversations with your clients and you talk about diversification, what does diversification mean in this environment where you're seeing stocks selling off, you're seeing bonds not providing that ballast that we're so used to them doing? How are they thinking about diversification?
Yeah, I believe diversification is not dead yet, right? So there's still hope for portfolio construction. But it's always in the very short term when there's a sense of panic selling and technical position cleaning, namely, involved by hedge funds and others who are very active traders. So that is actually an environment where everything tends to fall. If you look at the global stock market sell-off, almost every single region was damaged by these developments. And then it's really a lot about technicals, investors scrambling for cash, selling the last profitable positions, and even very sound fundamental investments are then being sold. So that's clearly not the few days or so which it normally lasts where diversification will help you much. But if you are a bit more, medium-term oriented, as most investors are, especially private clients, you will see that over time, over the next few weeks, there will be a divergent pattern of performance once again, and then maybe diversification will actually play again its benefit in the portfolios.
How are you looking at these tariffs? Are you seeing them as a negotiating tool, or are there an end goal?
Excellent question. So we published on that, and we think there's at least 3 types of tariffs. So we call it 3 shades of tariffs, if you like. So there's one which is, I think, very important. It's a source of income. And this is the one, let's say, structural tariff that will probably be around for years to come, that's our view, because we are in the midst of the budget negotiations in the US. So there needs to be long-term projections where the money should come from if, the Tax Cuts and Jobs Act, the TCJA program, which is about to be prolonged, which will cause significant costs, how this will be financed. So here we need a source of income, permanent one, which may be actually tariffs. So that's number one. The second is protection. So protection for the home industrial base will be for national security interests and so on. So that's clearly also one of the elements which will be probably with us for quite a while, if not years. And it might even make sense to some extent in certain industries. And then the third one is tariff as a threat, right? As a negotiating tool in order to achieve certain political goals. And I think it's really the mix of these 3. that will be very much moving markets going forward.
And those were some of the news driving the Southern African region for this week. You can, of course, catch these interviews again on our website on cnbcafrica.com. But for now, it's back to you, Akin.
Many thanks for the update there, Karabo. Let's catch up with content from East Africa with Tabitha.
Hello, Akin. It's been an exciting week across East Africa with some significant developments making waves in the region. Tanzania is pushing forward with an ambitious digital transformation agenda, with the government outlining a detailed ICT and communications roadmap for the 2024-25 fiscal year. CNBC Africa's Abiagina spoke to Jerry William Sila, the Minister of Communication and Information Technology, to discuss the country's key investment priorities for the sector. Let's roll in.
Tanzania, as you said, is doing very well economically, and in terms of ICT, it has a big commitment from Her Excellency herself, Honorable Dr. Samia Suluhu Hassan, where last year on 29th of July she launched the National Tanzania Digital Economy Strategy for 10 years. So her commitment toward the strategy, her commitment of forming a particular ministry to deal with ICT shows her commitment and the country's commitment toward the ICT. Now, as ICT is evolving and developing very fast, back then, 20, 30 years ago, it used to be used as a tool, from a typewriter to a computer to type letters, from a file cabinet to a small database to store data. But now it moved to be now a driving force toward every sector of the economy. So we are doing the same in Tanzania, we're doing so well. And we also have a national ICT investment policy, which now open up a vast investment portfolio for ICT development and investment. And ICT both act as a driver and as a sector by itself. A driver in terms of driving other sectors, in terms of facilitating agriculture, in terms of facilitating trade, online business, banking transaction, all move on an ICT infrastructure. And also the ICT itself in terms of ICT related industries, which also is a big platform for employment and provide its own contribution to the national economy. So that's, in a nutshell, is how an ICT sector is flourishing in Tanzania.
Excellent. And when you look at the ICT sector in East Africa, it has a lot of potential for growth. Looking at the digital economy that you just talked about, we are seeing a lot of interest in the young people to monetize through ICT. Just take me through what is the government doing, especially in supporting the digital economy, from infrastructure, from having the right systems in place.
Now, in terms of infrastructure, the way Tanzania is strategically, geographically located, we are having a national fiber backbone which span all over the country. We are 109 districts out of 139 districts, but currently now we are expanding to the rest of the remaining 30 districts. We are having undersea cable, 3 undersea cable connecting our country to the rest of the world, and now we are doing a redundancy connection through Tanga to Mombasa for another 7, because Mombasa is connected by 7 undersea cables. We are now having a project to cross Lake Tanganyika and connect to neighboring DRC Congo. We are already connected to Burundi, we're already connected to Malawi in terms of infrastructure, but currently the government is implementing a 758 base station project. We're having MNOs which have their own expansion project of more than 10,000 base stations, but now there are some underserved areas we don't have an access to a mobile broadband network, and now we are standing for 89% on a 2G, 91% on a 3G, and close to 94-95% for a 4G, and close 20% for 5G, so that mobile internet broadband connectivity in the country.
From neighboring Tanzania to the Horn of Africa, Djibouti is rapidly emerging as a key hub, attracting institutional partners. I spoke to Admasu Tadese, President and Managing Director of the Trade and Development Bank, about strategies for de-risking investment and strengthening local capital markets.
We've always looked to use local currency where possible, so we have had quite a bit of success in issuing local currency bonds in some of our countries. Of course, it's always limited by the capacity of the particular capital market. So we've issued in Tanzania, we've issued in Kenya, we've issued in Uganda, we've issued in the Seychelles. So we've seen how the capital markets are increasingly open, but of course, the capacity of the capital markets is not able to go very long at this stage. So they're not able to go to the full tenor extent that typically infrastructure requires. So there is capacity, there is scope, but it's going to be building up over time.
Indeed, and we're also seeing an increased focus on leveraging financial markets for growth. So what role does TDB, envision in strengthening local capital markets? You've mentioned capital markets quite a lot. So, in terms of, complementing traditional development finance, and also maybe you can tie this with some of the global shocks that we are seeing impacting the capital markets development.
Well, we've always been very much a partnership-orientated MDB, like many MDBs actually are. So we always look to complement domestic financial institutions. So it's always been that kind of posture we've had. Capital markets, we've not only sought to issue local currency bonds, but we've also, in some cases, invested in exchanges themselves. And so we've stimulated those institutions, we've given them a little bit of risk capital, and helped them take off in one or two cases. And so we've done that successfully, and of course just getting more issuances to trade on the exchanges. That's been an important part of the agenda, and we've managed to encourage some of our own clients to issue and to raise debt through capital markets. But again, it's still early stages, so we're not, I think South Africa is in a completely different space. South Africa's exchange is quite deep and wide, and it's got a lot of capacity. I think the rest of the continent is work in progress. South Africa's is also still, to some extent, work in progress, but it's a good story, that one.
And in terms of the global uncertainties, we are seeing here, the monetary policies, quite a lot that is happening, impacting capital markets. So how do we, mitigate some of the risks associated, when it comes to de-risking investments here?
Well, at least monetary policy has cooled down a bit. It had really heated up in the aftermath of the huge inflation shocks that reverberated across the world. It started in the dollar zone, but many local currency zones also had high inflation, much higher than the dollar zone. And that resulted in very high interest rates. And fortunately, the worst is behind us for now. And so it looks like rates have abated. There's a lot less pressure on that particular front. We will see how some of the new trade policy shocks reverberate into the monetary policy space. It's still too soon to say.
As the region continues to embrace innovation and investment, it's clear that strategic partnerships and a focus on financial stability will drive future growth. That's it from the region. Back to you, Akin.
Very true, Tabitha. Many thanks for the update there. Now let's switch gears now to unpack some numbers. The Africa Finance Corporation's revenue rose by 22.8%, reaching $1.1 billion. The infrastructure-focused multilateral finance institution says this was driven by improved asset yields, prudent cost of funds management, and sustained traction in advisory mandates. Net interest income also rose by 42.5%. Now, Ayotunde Anjorin, the Chief Financial Officer at the AFC, joined us earlier to unpack the numbers.
Well, 2024 was actually our strongest year ever. Like you said, we crossed the 1 billion revenue mark. It's interesting that you say that, because if you look at 2007, when we started, we were seeded with capital of 1.1 billion. And now, 18 years after, approximately 18 years, we're now at about 1.1 billion in terms of top line numbers revenue. So it's been a very fantastic year for us. Profitability is also very good. Profit grew by about 19.5% from $329 to about $393.9 million. And if you also look at the strong annuity revenues that we've had, if you look at the net interest income, that also grew robustly to about 614 million by about 42.5%. So it's been a very good year for us. On the total asset side, total asset also grew to about 16.7% to 14.4 billion from about $12.3 billion. And it's driven by strong growth on some key areas, which is the project finance in terms of loans to projects, and also on the investment security side.
All right, but I'm curious to know about your cost of funds strategy. Okay, and what role did that play in terms of improving the outcome of your net interest income by about 40%?
Yes, so we run a dynamic, I would say, balance sheet optimization strategy. As you're aware, AFC is investment grade, third highest investment grade institution in Africa. So which means that we have access to diversified sources of funds. So if you look at how we manage our cost of funding, we also always would look at how we ensure that we're able to match our assets with the liabilities in terms of the funding. And because we have diverse access to pool of capital across the globe, not even in Africa, across the globe, we are able to optimize and also improve and ensure that our cost of fund remains competitive. As you're aware, we need that cost of funds to be competitive for us to be able to close and also run some of the projects that we're investing in.
Because I see that your fees and commission income is about at 5-year highs.
Yes.
I'm curious to know what drove that uptick as well.
Okay, so yes, you're right. Fees and commission, I think it grew by about 55% from about north of 70 million to about $110 million. And the growth is mainly on the back of asset velocity that we had in the book. So if you look at the asset growth in terms of disbursement that we had in 2024, we disbursed over 2 billion worth of assets in terms of funding projects, project finance type, trade finance types. On the back of that, we're also able to leverage in terms of our structuring capabilities and advisory capabilities to earn fee-based income. So that's what actually drove the numbers for 2024.
Still digesting some numbers here. African multilateral financial institution Afreximbank has posted a 28.7% growth in its profit after tax to $973.5 million in the 2024 financial year. Gross income increased by 23% to $3.3 billion in the same period. Dennis Denia, Senior Executive Vice President at Afreximbank, says despite geopolitical tensions and other headwinds, the performance of the bank's subsidiaries drove the positive result. He joined us earlier to unpack the numbers.
2024 was a difficult year for the African continent, and Afreximbank is a continental bank. So we faced the same headwinds that we faced previously. The debt situation for the sovereigns remained high. A number of countries were downgraded by rating agencies. So there was a number of challenges. The insecurity, especially in the Sahel region, also delayed projects. But notwithstanding these challenges, the African Export-Import Bank Group delivered what I believe are excellent results. Even if you look at the top line, our net income really grew by 29% over 2023. If you look at our non-funded income, if you break your income between interest income and non-interest income grew by 26%, which is comprised of your advisory fees, your guarantees, your LCs. If you look at the underlying assets themselves, loans and advances grew by almost 9%, guarantees and letters of credit grew by 26%. So it was a good growth across the board. If you talk about geographical spread, we made significant progress in the new areas that we set up our operations. We currently are in the six regions on the continent, plus Barbados to cover the CARICOM, and we registered significant growth. If you look at the makeup of the group itself, the bank did very well, but so did the Fund for Export Development. It did extremely well, generating net income of $35 million. The new baby, the Afreximbank, delivered pleasing results. We wrote policies of over $3.5 billion, generating just about $12 million. So across the board, we made significant progress.
And it's quite interesting because this is all, in the context of slower than expected growth, on the African region. I think the bank was projecting somewhere around 4%, but so it's coming in at 3.5%.
Yes, whilst the GDP of the continent didn't grow as expected, even below the world average of 4%, the bank's operations grew. We had activities in 47 of the 54 African countries. So that was a big growth on prior year. We also had exposures in 10 of the Caribbean countries for the first time. So our activities compensated for the lower growth in GDP, which was pleasing. But the growth didn't come at the expense of the quality of the loan book. It actually improved. Our non-performing loans improved to 2.33% last year. Even if you look at the staging of our portfolio, stage 1, stage 2, and stage 3, stage 1 is over 91%, stage 2 and 3 also declined. So we have a good quality portfolio as we go into 2025.
Right, and let's go now into 2025. What will be the focus? I know obviously you're big on infrastructure, but are you looking at other new frontiers, or what would be the highlights for this year for you?
For 2025, we continue to push for the implementation of the AfCFTA. Given what is happening with the tariffs, actually it's very, very important now that Africa services its domestic markets first. So we need to trade more amongst ourselves. So that's our focus area. At the end of 2024, our intra-African trade was 36% of our loan book. We need to grow it further.
This is where we draw the curtain on this episode. Thank you for joining us on Africa Business Weekly this week. Until next time, stay informed and stay ahead. I'm Akin Opakeye.